Hi friends, today we will learn about current ratio, its formula, what it is, meaning and how to calculate it. Now what is current ratio? Current ratio or working ratio is the ability of a business to pay its short-term obligations that are due within a year. It measures the business current assets against current liability. It is that liquidity ratio which gives investors and analysts an idea about the company's financial health and how it can maximize its current assets to meet its current debts and payables. Now, what is the formula to calculate current ratio? The formula is current ratio is equal to current assets divided by current liabilities. What are the current assets? Current assets are the resources that can readily convert a liquid cash within a year. It includes cash, that is petty cash, legal tender bills, checking, saving accounts, coins. Okay, cash means all this. Then cash equivalents. What are cash equivalents? Corporate or government securities within a maturity of 90 days or less. Now, marketable securities, that is common stock, preferred stock, government and corporate bonds with maturity of 1 year or less. These are the marketable securities. Then account receivables. These are the debtors, that is money due within a year by customers to the company. Then inventory, you all know, raw material, finished goods, work in progress. It may also include stores, etc. And then prepaid expenses, which may include unexpired insurance premium, advance payment. All these are the current assets. Right, now what are current liabilities? Current liabilities are the financial obligations and other payments due to suppliers and creditors within a year, 1 year, that is short term. Now it includes account payable, credits earned by purchasing raw material, supplies, merchandise. Basically it is the creditors of the company. The notes payable, loans that are coming due in a year to have interest and principal paid. Then deferred revenue, the payment earned in advance by the company for earnings that will happen once revenue recognition requirements are satisfied. That is the advance that a company receives to sell its goods. Okay, I hope it is clear. Then accrued expenses, that is due income and payroll taxes that we have to pay, which are the expenses which have accrued but the payment has not been made. Interest payable, then accrued expenses made without receiving an invoice. Let us now come to the example to understand current ratio. To understand the example, let's calculate current ratio of Apple Incorporation for the fiscal year 2017 using current ratio formula discussed above. As above in the balance sheet, total currents of the company are 128.65 billion dollars and total current liabilities are 100.81 billion dollars. Thus the current ratio is 128.65 divided by 100.81. So when we calculate it, it comes as 1.28. This result suggests that Apple has enough resources to meet its liability, including indicating good financial health. Now, what are the current ratios versus other liquidity ratios? Other comparable liquidity ratio can also be used to find numbers, and the current ratio analysis gives us. An investor can learn more about the current state of the company's assets and liabilities by understanding how these metrics evolve over time and differ in the scenario. The most commonly used among this is asset test ratio. It contrasts a company's obligation with its quickly liquidated assets excluding inventories. The asset test ratio, or we can say the quick asset ratio, is the same as current ratio, only the inventories are excluded, inventories and prepaid expenses, because inventories are usually long term sort of, uh, right? Similarly, the cash asset ratio, cash ratio, simply evaluates a company's cash and marketable holdings in relation to its current liabilities. In cash ratio, only cash is included, right? Another metric, the operational cash flow ratio, compares the company's active cash flow from operating operating activities to its current liabilities. Investors, creditors, and suppliers make decisions based on their understanding on the current ratio. Thus, the current ratio is crucial for determining whether company's interest is viable. Now, what is the significance of current ratio? The current ratio proves to be a very effective financial tool in measuring a firm's liquidity. Here are few significant benefits of using current ratio. The current ratio helps determines the immediately financial standing of the company. It also assesses the ability of the firm to manage its creditors. The current ratio helps a company to understand the working capital needs. The higher the ratio, the higher the liquidity of the firm and the better stability. This ratio also determines the operating cycle and its sales generating capability, right? The current ratio can help you optimize your overhead expenses and better plan inventory storage. The current ratio can also help you make important investment related decisions. Now, what are the limitations of current ratio? Among the many advantages of using the current ratio, you will have to be careful about the following drawbacks, right? A few of them are, there needs to be more than current ratio to determine the liquidity accurately. The ratio measures only the quantitative aspect while neglecting the qualitative elements of the current assets, right? Like the inventory, the quality, the that is neglected. It is also not a very accurate measure of company's financial health since it doesn't account for absolute produce or sales frequency, right? One might be able to observe a discrepancy in ratio of companies that have seasonal sales. In that also this may not work. The ratio is also easily affected by a change in the method of inventory valuation. If you change the valuation, this may not work properly. It is relatively easy to manipulate current ratio, so it does not always provide a 100% accurate. Now, what is the good current ratio? The definition of good current ratio is totally dependent on the environment of the sector in which the company's analysis takes place. For instance, in retail business, often a high current ratio, whereas service sector business typically have low ratios. A current ratio is of less than 1 typically means that company may only go bankrupt within a year if it grows its current cash flow to meet current liabilities. On the other hand, a ratio of 1 can be seen as safe because it does not indicate any significant liquidity ratio. Hence, a current ratio of a more than 1 is generally preferable. The current ratio, however, is a typical, not an accurate picture of company's short-term liquidity or long-term solvency because it is only a snapshot at any given time. Now, what is the conclusion with all this, what we have learned? In conclusion, the current ratio accurately indicates a firm's liquidity when combined with other strong financial indicators. Additionally, makes it possible for investors, stockholders, and business owners to assess the company's financial situation and near-term prospects easily, like in short term. However, liquidity ratios alone should not be used to determine whether or not to invest in a company, and one should consider a person's age, income, capacity for danger, and financial objectives. Right? I hope the entire thing is clear. Okay. Thank you for watching.